The Bank of England just did the unthinkable, and the UK is on the brink of collapse. What is the end game? How is this going to play out? And is there any systemic risk with other economies, such as the United States? I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over this new plan or mini plan from Liz Truss. Here she is right here holding a sign, and I don't care what side of the political aisle she's on. She is all about Keynesian economics. So she is holding this sign very proudly that says, "I love Keynes." And in a moment, you will see why. So let's go over a plan. Pretty simple. Let's cut taxes and increase government spending. Okay, so how did she propose specifically to cut taxes? Now, what's interesting, first and foremost, is I looked for her actual plan, word for word, online for hours, and I couldn't find it. So my first impression is there's most likely a propaganda campaign towards Miss Truss in the mainstream media. They don't want you to know the details. They just want it, make it very ambiguous, make it emotional, make it seem like it's the worst thing since communism. Now, I'm not saying that her plan is great. In fact, I don't really like it. But it's not to say that the media is treating her fairly. Okay, let's get back to the video here. So we've got business owner Bob, and he owns a house in the UK. So he is winning big time. Why? Because Miss Truss is reducing the real estate tax. And over there, they call it a stamp tax or stamp duty tax, I believe. And back in 1776, the Americans didn't like that too much, or during the Revolutionary War. But they still have it over in the UK, and I've seen it in many other countries. Basically, it's just a transaction tax. So we'll just call it a real estate tax. So that's going to be lowered, or the threshold where this tax applies is going to be raised on the nominal value or price of the transaction. So business owner Bob is winning because he just sold or purchased a home. Now, he's also incredibly productive, as you can see right here, because he's on my whiteboard with an iPad. He doesn't even have time to be on the whiteboard if he's not working and producing goods and services. So he's got that whiteboard cranking out emails as we speak, and he's making a little bit of money. So Ms. Truss has reduced his tax rate from about 45 down to 40%. She also did it for Moody the Millennial, or the average Joe, taking their tax rate down from 20 to 19. I believe this is the lowest income tax rate. And I think the main reason she dropped the lowest income tax rate from 20 to 19%, just 1%, is so her political opponents would have a harder time attacking her. But back to the specifics. We've got Bankster Bill, and you can tell because he's got his top hat and his eyes are money signs. And he is super excited because Liz Truss just raised or eliminated the cap on his annual bonus. So this is good news for Bankster Bill. And we've got Bond Fund Barry. The bald guy with glasses that looks like Milton Friedman. You can tell he's a bond fund manager for sure. And he is super stoked because, like business owner Bob, his tax rate went from 45 down to about 40%. So before, their take-home pay, after they had paid their taxes, was this: $1 sign, $3 signs, $3 signs. We'll just convert it into British pounds. It's about the same. It's about at parity right now anyway. But after Liz Truss's plan, you can see they have much more money to spend into the economy. And like all good Keynesians, Liz Truss believes that all you have to do is increase aggregate demand, no matter how you do it, and you're going to get real economic growth. Most of you watching this video right now know that's utter nonsense. It's not about just increasing aggregate demand. It's about creating more goods and services. So you have to look at these tax cuts and say, okay, well, it's really for people in the financial industry or the financial economy. How is that going to create more goods and services? So I always like tax cuts, but if you're going to cut taxes, you got to do it in a way that will promote the increase of goods and services and economic output in the real economy, not just the financial economy. The other part of her plan is to increase government spending. And when they increase government spending, basically what happens is the government just issues more bonds. They're called gilts, basically the equivalent of treasuries here in the United States. And the real economy, the private entities in the real economy, or the banks, they go ahead and buy these gilts. So the gilts go onto the balance sheet of the entities in the real economy as assets. And those dollars or British pounds go to the government. They go on their balance sheet, and the government spends those pounds into the real economy. So on net balance, they aren't really increasing the amount of currency units, but they're just taking it from one group and giving it to another group. This most likely does increase velocity, and it definitely distorts the economy with malinvestment and a misallocation of resources, which most likely exacerbates inflation. More on that in step number 2. So a lot of people in the mainstream media and economists have attacked this plan, saying that the deficits are going to blow out. And they most likely will, because initially you see tax revenue decrease while you're waiting for that mysterious economic growth from, I hate to use the term trickle-down economics because it's just so nonsensical. It doesn't really mean anything. But we'll say the wealth effect, because that's something the Fed has been trying to promote here in the United States since 2008. But the criticism of her plan is it's going to blow out deficits and it's going to increase the government debt to GDP. And to a certain degree, I would agree with her critics. Now, I want to be very, very clear. If you were to cut taxes in a way that promoted economic growth in the real economy, and you decreased government spending, and that's key. You can't just decrease the taxes and increase government spending. This is nonsense. This is Keynesian economics, all demand side. That all we have to do is increase aggregate demand over here and increase aggregate demand with government spending, and we're off to the races. Absolutely not. In my view, this actually would have been a decent plan if we had had more targeted tax cuts to promote growth, not just financial assets, and you were to decrease government spending, shrink the size of government to the same degree to which you reduced tax revenue short term. This would be a fantastic plan for future growth. Short term, you definitely have a recession, but long term, you would see sustained, healthy economic growth. So, just to recap here to make sure we're all on the same page, what Liz Truss wants to do is increase government spending to avoid any type of short-term pain. She wants to make sure the UK doesn't go into a recession by cutting government spending, which she should be doing. Then she knows the government deficits are going to blow out, and so is the government debt. But her plan is to have economic growth, which is represented by this blue line, continue to go up at the same rate as government spending, government deficits, and the debt. And it is true that short term, the tax revenue will go down, represented by this green line. But in her world view, over time, the tax revenue will catch up because of all this economic growth. And then eventually it will exceed the level of tax revenue they were collecting before the mini budget from Liz Truss went into effect. Step number 2. Unfortunately for Liz and pretty much the entire UK, her plan created economic chaos. Imagine that, a central planner's plan having unintended consequences. Who would have thought? So basically what happens is Bond Fund Barry looks at all of the government spending, the government deficits, and tax revenue going down, therefore demand going up, and starts freaking out, as you can see right here. He says, whoa, 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 time out, Liz. Inflation is already at around 9%, and you're going to increase aggregate demand and you're going to increase government spending. This is going to make inflation far, far worse. And keep in mind, Barry owns bonds. So he's being paid back in nominal terms, not adjusted for inflation. So what is he going to do with all of those bonds denominated in British pounds? He's going to sell them. So he sells the bonds, and then in return, he gets pounds. Well, he doesn't want those pounds either. He wants assets denominated in another currency, like the dollar. So he sells the pounds, buys dollars. This creates an even further supply-demand imbalance between the two currencies. So what happens? The pound sterling tanks and the dollar goes up, which is exactly what we've seen. Well, what does this do? This creates even more domestic inflation, or gives domestic inflation in the UK even more of a tailwind, which prompts Barry, the bond fund guy, to sell even more bonds. And this just exacerbates the problem, which is why I'm illustrating it here in a doom loop. Well, editor, go ahead and throw up the rates on the 10-year gilt in the UK. And we can see they have exploded higher, which makes sense because you have more selling, which means less demand, more supply, price goes down, therefore interest rate goes up. Well, this is a big problem, and it leads to one of the many unintended consequences from the central planners, the Keynesians, and Liz's mini budget or mini plan, whatever it is. And this brings us to our next guy here, who looks oddly like Barry. This is Pension Fund Pete. Maybe he's Barry's cousin. Got a little bit different haircut, though. So Pension Fund Pete is also looking at Liz's plan and freaking out. Why? Because he's looking at his balance sheet. He's got assets on the left, liabilities on the right, and one of his main assets are government bonds. Well, he is taking a massive haircut on his government bonds. They are decreasing in price. So let's just assume that to begin with, he had $1 billion worth of assets and $1 billion worth of liabilities. Well, the bond market completely collapses because of this doom vortex we were talking about earlier. Rates going up, therefore price going down. So now he looks at his balance sheet and he's only got $500 million in assets for, let's say, $1 billion in liabilities. This gets the attention of the Bank of England. They can't have all of their pension funds blowing up. So they come in, and keep in mind, this is during a time which they're trying to do quantitative tightening. And they have to say, oh, whoa, 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 sorry about that. We're going to go ahead and take that quantitative tightening, put it on the shelf for a moment, and we're going to start a new round of, you guessed it, quantitative easing in a time frame or a period in which inflation is running at 9% plus. And because they're combining quantitative easing with the massive government deficit spending, this is going to increase the M2 money supply, which does what? Creates more currency units chasing goods and services, which makes the CPI go even higher, which exacerbates this entire problem. So what do? Well, to combat this, while they're doing quantitative easing, to try to bring down the rates or calm down the bond market on the long end of the yield curve, they are simultaneously increasing rates at the short end of the curve. So because they're doing quantitative easing, now they have to increase their overnight rate even more, which puts further pressure on the real economy and which tanks the stock market, which is exactly what we have seen over the past week. Step number 3. So what is the end game? what is my prediction for the future, let's say in the short term, midterm, for the UK economy? Well, oddly enough, they just asked Mr. T the exact same question. Editor, cut to the clip.
What's your prediction for the fight then?
Prediction?
Yes, prediction.
Pain.
And hat tip to my good buddy Adam Taggart over at Wealthion for the great idea for the Mr. T clip. Okay, let's get into this chart. We go all the way back to 1880, all the way to 2017. Not totally up to date, but you get the idea. You get the concept. This is the UK trade deficit as far as the goods that are imported into the UK or exported. Going all the way back to 1880, pretty much balanced. They exported about the same as they imported as far as goods. Now, over on the left, we've got negative 50 billion, I assume British pounds, 100, and it goes all the way down to negative 120 billion. So all the way to pretty much 1971, the UK trade deficit as far as goods was about zero, pretty much in balance. But then they started to understand they could consume far more than they produce. And they consumed and consumed and consumed and produced less and less and less, to the point where in 2017, their trade deficit in goods was about 120 billion. That is a staggering amount. So the bottom line here, what you have to understand, is the UK currently is importing way, way more stuff than it is exporting. Well, how does it pay for the majority of those goods? Not in British pounds, but in US dollars. So let's use an example of everyone's favorite business owner, Bob. We saw him in step number 1, and he's still got his iPad here being extremely productive. Well, he owns a factory that produces chemicals. So one of his inputs for the chemicals, natural gas. Well, when he buys natural gas from, I don't know, China that buys it from, let's just say, Russia, he has to pay for it in dollars. There's a problem. Bob's revenue is denominated in British pounds. So he takes the nat gas, creates the goods, sells the goods to the average Joe in the UK. The average Joe pays him in pounds, but then he has to take those pounds, sell them, buy dollars to buy the natural gas that he needs for the input for his chemicals. But you see the problem here. This creates additional supply of pounds, additional demand for dollars, especially if the price of this commodity denominated in dollars is going up. Let's think this through. If this barrel of natural gas costs $50, well, he's going to have to sell far fewer British pounds. But if this natural gas costs $100, let's say $1,000 to take it to an extreme, now he needs far more British pounds, has to sell them in order to get the dollars he needs for that crucial input, or else he goes bust. I'd also like to add, Bob would most likely have to increase his prices, which put further pressure on the average Joe. If the average Joe desperately needed, the products Bob is producing, he would have to spend less somewhere else in order to afford the additional cost of, let's say, widget XYZ, or the end chemicals Bob is producing. This puts further downward pressure on the economy in the UK, and it potentially exacerbates inflation even further. Oh, but wait, there is more. Let's move on to everyone's favorite bankster, Bill. And he still has these dollar signs in his eyes because Liz said that we're not going to put a cap on your bonuses. So that makes Bill very, very happy. So he looks at his balance sheet, assets on the left, liabilities on the right. He says, okay, right now I've got some deposits, got some loans, but I really want to expand the size of my balance sheet because my bonuses can go to infinity and beyond. I'm going to go out and get that summer house out in the country, and I'm going to buy that Maserati. So let's go ahead and lever up and increase the size of the balance sheet. But in order to increase the size of his balance sheet, he needs pristine collateral. And the only pristine collateral out there, or the best collateral out there right now, would be U.S. Treasuries. More specifically, U.S. T-bills. So this increases the demand for T-bills, especially the 1 month, which is why you can see the yield on the 1 month T-bill trading so much lower than reverse repo, which is basically parking cash at the Fed risk-free. But I don't want to go too far down that rabbit hole. We'll save that for another video. The bottom line is, in order to get the treasuries or T-bills Bill needs to lever up his balance sheet to get that bigger bonus, he needs dollars. Well, he's got to sell British pounds to get that, right? So it's the exact same process that we discussed with Bob. You're increasing the supply of British pounds circulating in the global economy, and you're increasing demand for dollars. But that's not where our story ends with everyone's favorite bankster, Bill. Let's think about this. As the UK economy is suffering from the Keynesian policies of Liz, this increases the perceived counterparty risk. And remember, he wants to lever up his balance sheet. So he's going to have to borrow a lot more money. He needs those treasuries as collateral. But with the entities, the counterparties that are looking at Bill, they're saying, well, there's a lot more risk. So Bill, we're going to need a lot more collateral. So if Bill has to buy even more collateral because of increased counterparty risk, he needs more dollars. This makes the dollar demand go up, which makes the dollar appreciate. In other words, the pound depreciate in value. Also, with increased risk, you have a decrease in the multiplier. Let's remember that they're taking these treasuries, i.e. collateral, and they're rehypothecating them, meaning the financial institutions, the primary dealers, as an example. So that means there's less collateral available in the system. Because let's just assume currently they can take one piece of collateral, one treasury, and use it 20 times. Well, now, if they can only use it 5 times, well, there's going to be additional demand for existing treasuries, which means the price goes up. If the price goes up, Bill has to come up with more dollars for those treasuries he needs to expand his balance sheet and get that bonus. Oh, but let's not forget Bond Fund Barry. Remember the doom vortex in step number 2, where he had all of those bonds, he wanted to sell them to transition into dollar-based assets, most likely dollar debt or dollar bonds, maybe corporate bonds, maybe treasuries. Well, it's the exact same thing we talked about here. He's going to need dollars to do that, and this puts further downward pressure on the British pound. So everything we've discussed in step number 3 really leads to one thing. This is the dollar acting as a wrecking ball on the UK economy. In fact, my editors have told me we have an exclusive video clip just for the George Gammon channel of what the dollar is doing to the UK as we speak. Editor, cut to the clip.
Hi, 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 hi.
And this puts the BOE, the Bank of England, into a position where it has to do the unthinkable. It has to actually increase the amount of quantitative easing that it's already committed to, which puts further pressure on consumer price inflation, which would make them increase the overnight rate even further, which would put even more downward pressure or increase the probabilities of a complete collapse of the UK economy. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.